Minority Sale Book Building, Part 2. This is Lesson 3 of Class 1. In this lesson, we will review the steps and procedures while raising minority capital and the main operational differences that practitioners should keep in mind when raising capital as opposed to a majority full sale. Background. In Part 1 of this lesson, we covered the main procedural differences between a majority and a minority deal. In Part 2, we will continue to review capital raising procedures by disaggregating capital between debt and equity, and explaining best practices when advising clients throughout their capital formation. Additional background. Capital raising is a massive practice that includes a wide array of activities ranging from initial public offerings to debt syndications. For the purposes of this lesson, let's focus on capital raises that support the capital formation of a business. Capital formation usually refers to minority capital entering a business to maintain and expand operations. When thinking about a client's capital formation, practitioners need to find the right solution for each client based on their business, their current financial position, and their future goals. In this section, we'll review and further define the capital markets and the procedures associated with advising on capital formation. We will also break down the capital markets into two broad categories: the equity capital markets, ECM, and the debt capital markets, DCM. Intro to equity capital markets. Equity capital markets. This is a marketplace of participants that seek to trade equity in exchange for capital. Participants. Sellers. They provide equity ownership in exchange for capital. The investor. They provide capital in exchange for an equity position. Types of capital. Primary capital. This is capital that is exchanged directly between the investor and the company, resulting in newly formed equity shares. Secondary capital. This is capital that provides liquidity to existing shareholders, allowing cap table members to exit their current positions. Categories of equity capital. Venture capital. Equity capital that seeds the business and helps the company begin operations. And then there's growth capital. This is equity capital that funds development and allows the company to scale operations. ECM deal structure. Raising a client's initial equity capital is a very important responsibility, and there are many considerations that practitioners need to keep in mind when structuring deals. For example, deal quantum, deal pricing, and investor rights. Deal quantum and deal pricing. Deal quantum. Practitioners need to keep in mind the size of the round and ensure that the client isn't taking on too much capital too early in their capital formation. Small, fast-growing businesses that take in too much equity capital early on end up forfeiting an unreasonable amount of ownership. Deal pricing. Practitioners need to conduct valuation exercises to ensure fair pricing around the deal. In the capital formation of a business, practitioners will likely be advising non-public clients who want to raise capital in private market offerings. Private market equity offerings do not involve retail investors and public exchanges. Therefore, when we think of pricing, it is not in terms of pricing per share, rather it is in terms of company valuation. For example, the client is raising $5 million in equity capital for 10% of the company. This would imply a company valuation of $50 million. The price per share is simply implied by the number of shares issued in exchange for the $5 million of capital. For example, if the investor received 1 million shares in exchange for a $5 million investment, then this would mean each share is worth $5. Investor rights. Early non-controlling investors take on a substantial risk when seeding the company with its initial capital. Therefore, the investors structure the term sheets in a manner that awards them additional rights that would not otherwise be provided. Such rights could include liquidation preferences, the dollar amount that the investor would receive upon the liquidation of the company, usually stated in a multiple of the original investment. For example, 1x, 2x, or 3x liquidity preference. Participating equity. This allows the investor to participate in the pro rata share of the company's proceeds following a liquidation event beyond the investor's liquidity preference. For example, if the investor has a participating preferred 2x liquidity preference, then the investor would receive 2x his or her initial investment, in addition to sharing in the pro rata distribution of proceeds along with the common equity holders. Investor rights continued. Additional investor rights include conversion options. This allows preferred investors to convert their position into common equity and take a bigger part of the upside. Anti-dilution rights. This allows the investor to participate pro-ratably in future primary capital raises to maintain their current ownership position. Veto rights. This allows the investor to veto certain corporate actions. such as M&A deals or debt issuance. Board seats. This gives the investor the option to participate on the company's board, which provides the investor with direct influence over the management team and the corporate governance of the business. Thank you for tuning into this video. We look forward to seeing you at our next video, which will be part 3 of minority sale book building.